Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
In all this reporting about the new administration and the Treasury pick, I've heard the number bandied about that the U.S. Treasury market is $28 trillion in size.
It's large,
so
let's say.
That means I have to be a little bit nicer to our next guest than I typically am. Ira Jersey joins us. I didn't know he was so influential, $28 trillion. Ira, do you care, or to what extent does your market care about who President-elect Trump selects as Secretary of the Treasury?
Well, so people have been talking about who it's going to be, and you know, there's a mantra at the Treasury Department that typically is they want to be regular and predictable in terms of how they issue debt. So if you wind up with any of the three main picks that we've been hearing about, I don't suspect that you'll see a major seed change from that, but they do influence how many of which securities are issued. In fact, when the Treasury Borrowing Advisory Committee, that's a committee of investors and dealers and the like, when they get together, they actually send a recommendation to the Treasury Secretary of how things should be issued. Now, in reality, you know, the Treasury Secretary kind of signs off on it, but it's mostly the decisions are made by the people under the Treasury Secretary. But I think that you know, all three of these picks are reasonably middle of the road in terms of you know, how they're going to operate the Treasury Department, in my opinion. And look, I haven't had any discussions with any of these folks, but I don't think that they're really outside of the realm of what we might expect as normal, especially since two of them are very much markets people, and they don't want to rock the boat. They'll get feedback from markets and market participants and investors before they make any sweeping changes to how treasuries are issued, which treasuries are issued, and the like.
T-back, that's what the cool kids call it. Ira, it's good to chat with you. So I was out of commission for about a month and a half. And when that happened, you know, we're looking at Treasury yields around like 3.6%. It was like, all right, guys, we're going to move money out of Treasuries and we're going to put it into stocks. That's where the return's going to be. And then I come into the office and we're close to 4.5. That's a big shift. How high do we stay for how long? And is that thesis then, look, guys, you still got to put money in the long end?
Well, so I do think that there's a cap on how high Treasury yields are going to be able to go. There's going to be kind of this supply-demand balance that probably is somewhere between 4.5% and 5%, particularly in long-term Treasuries, just because the higher yields go from here, the more we get into the place where liability managers tend to really like bond yields, and especially unless you get you know, a really big shift up in inflation, there's no reason to think that we won't stabilize somewhere in this area. So our view is we'll wind up staying in a pretty wide range over the next year, smaller range than we had the past year. Remember, over the past year, we've been between 5% and 3.5%, right? So 150 basis point range. I think it's probably a bit narrower than that over the next year, but we still wind up being volatile in that range. More important is going to be as important is going to be the curve, I think, and where do two-year yields go, which is far less certain because we don't know how far the Fed's going to cut, right? The Fed's probably going to cut at least a little bit more, but are they only going to cut another 75 basis points as the market expects, or are they going to cut another 150 to 200 basis points like we thought just when, you know, before you went out on break? Because that's really been the big move, and the reason why we've seen this massive sell-off in Treasuries is just a shifting expectation for what the Fed's going to do.
So what will we get at the December 18th meeting is, I guess I've heard the word skip used. It's the first time I've heard that, but is skipping the December meeting in terms of rate cuts, is that reasonable, or do you think they're going to move forward?
Yeah, Paul, I do think that there is the big distinct possibility that they skip in December. You heard some language out of Chair Powell over the last week that basically hinted that they might do that. So you wind up getting an okay payroll report, an okay CPI report, and you wind up with maybe a skip. The market right now, keep in mind, is basically pricing a skip in either December or January. So basically one cut between the two meetings, kind of unsure which one is of those two meetings is going to be the skip.
What's interesting, though, is that it feels like we priced out a lot of the drama and the rate cuts that we had already priced in, say, over the summer. So are we sort of at neutral, in essence, in terms of what the market actually expects versus what the Fed's actually going to deliver?
Well, the market seems to think that maybe if the Fed's going to get back to neutral, that maybe the neutral rate is 3.75% to 4%, because that's what the market's priced for where the Fed's going to get to. So again, a little bit more in terms of cuts, but not down to 2.75% where we were priced very briefly for a cup of coffee back in September. So so I do think that the market believes that neutral is higher. I think the Fed is skeptical of that, right? Which is the reason why the Fed, I think, thinks that they might need to remain restrictive a little bit longer, and they do think that they're restrictive, right? Almost every single member of the Fed has said that they're restrictive. But the question is how restrictive, and will the Fed, when they get to restrictive, how long then will they stay there? And that's one reason why you have 2-year yields that kind of can't make up their mind whether or not they want to be at 4% or 4.25%. And I suspect that 2-year yields will wind up back at 4, even under 4% by the end of next year. But there's still, that's incremental tightening or easing by the Federal Reserve over the course of that period of time. And unless we get a recession, it's hard to see how the yield curve significantly steepens from here, unless you wind up with some kind of deficit shock where the Treasury Department has to go out and issue a whole lot of long-term debt. It's possible, but that I think is kind of an edge case scenario.
All right, Ira, thank you so much. As always, appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us from the BI headquarters down there in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. We also like to tap them outside of Bloomberg as well to get a good read on what's actually happening in the market. If you're putting money to work, what's the smartest way to do that? Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federates Hermes, joins me now. Phil, what's the case for not being in equities?
Well, the stock market has had a phenomenal run here. Animal spirits have returned, and from the bottom of the market in early to mid-August, a lot of the indices are up 15 to 20%. So the case for not being in equities or being underweight equities at the moment is perhaps you think stocks are overvalued near term, and you'd like to be patient and get a better reentry point in order to get back to an overweight. But if we're taking a longer cycle position and looking at the prospect of less regulation, lower tax rates, both individual and corporate, stronger economic growth, all of those things are good for corporate earnings. Ultimately, share prices reflect stronger earnings, and we could see the S&P 500, from 6,000 now, let's call it, up into the 7,500 neighborhood as we look out over the next couple of years.
So, Phil, to what extent did your, market call change the day after the election when it became apparent that not only President-elect Donald Trump coming back to the White House, but it looks like he's going to have a pretty solid Republican support in Congress? How has that impacted your call?
The good news, Paul, is it did absolutely nothing to our call, because we were expecting a red wave, if you will, and had positioned for that accordingly in terms of overweights in domestic large cap value and the small cap categories. We had been essentially fading the dramatic outperformance of the Mag 7 names over the 18-month period into the middle of this year. And, as you look back on the third quarter and results over the last, 6 weeks or so, the values in the small caps have had a pretty good run of it. So we didn't need to make any changes after the election results became known.
What other thing I was just talking about that struck me was the rise in 10-year yield, almost at 4.5%, and the continued money into money market funds. Is that ever going to leave?
Well, there's a concern that's growing based upon developments over just the course of the last week, Alix, and I think we've seen this with the backup in Treasury yields. We were at 350, 360 or so a couple of months ago. We're now up in that 440, 450 neighborhood. And the question is whether or not we're going to go back and retest, the 475 or 5% level we saw, October of last year. The reasons for that backup, in our view, is that inflation is not going down anymore. It's sort of stalled, and based upon the wholesale inflation metrics we saw last week, are actually starting to reaccelerate. As we look ahead to the core personal consumption expenditure index that we're going to get, I think, the day after Thanksgiving, the expectation is that number is going to continue to go up as well to 2.8%. Remember, the Fed's target there is 2%. You had some pretty strong economic growth in the second and third quarters, GDP, compared to the first quarter. Last week's retail sales numbers, upward revisions in September, some strong nominal or headline numbers out of October. So the thinking is that the economy's strong, inflation is sticky and persistent. You've got a red wave here that in all likelihood is going to result in stronger economic growth. Maybe the Fed's not on a glide path to, take the funds rate down to 3%, which was sort of the gist of what most investors got out of their SEP back on September 18th.
So given that backdrop, Phil, where's your best opportunity after that as you look at the equity markets here? Where are you guys focusing these days?
Well, again, we're taking a longer-term view in that if we're right, that the issues that we just talked about do result in, our forecast is $350 in corporate earnings for the S&P, looking out to calendar 27. Embedded in that assumption is comparable or perhaps lower corporate tax rates and extension of the individual tax rates at the end of next year, the end of calendar 25, when they come up for renewal. Right. So as a result, as we look out to 26 and 27, the economy ought to do pretty well. So if we discount back $350 in earnings into the end of 26, that would suggest the 7,500 S&P, we're trading at 6,000 now. So if the market does pull back here, let's say we pull back to the 200-day moving average, roughly about 5,400, that gives you a couple of thousand points in the S&P potentially the upside over the next couple of years. That looks pretty attractive to us.
It sounds pretty attractive to me, certainly. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federates Hermes. Thank you for your time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Happy Monday, everybody. Alix here alongside Paul Sweeney. This is Bloomberg Intelligence. We are broadcasting to you live on this lovely Monday morning from our interactive broker studio right here in Midtown Manhattan. It may be a lovely morning for us, but maybe not so much for Spirit Airlines. The company declares Chapter 11 bankruptcy. It's seeking Chapter 11 protection in New York to restructure about $1.6 billion of debt. It did tell customers on Monday that they should continue feeling comfortable booking flights now and in the future. I don't
really.
Yeah,
okay.
I guess that stock is obviously halted for bankruptcy protection filing. We wanted to get the latest now with Francois Duflot. He is US Airline Analyst with Bloomberg News. He joins us. Bloomberg Intelligence, I think. Yeah?
Yes, exactly.
Okay, Bloomberg
Yes.
Intelligence. That's important. We want to sparse that out. What happens to Spirit? What does this process wind up looking like?
Yeah, so good morning. Spirit have been struggling since 2020 with losses and cash burns. Things have got only worse since 2023 after the merger with JetBlue was blocked and Pratt & Whitney announced the need for some engines to be inspected, and that grounded some 24 aircraft for this year. So with everything, unit costs have increased faster than revenue, both because of inflationary effects and also strong competition. And so there was this need of refinance 1.1 billion of debt raised during the pandemic that was backed by a loyalty program. And that was due on September 2025. And there is another 500 million convertible debt due in 2026. And because of this cash burn and losses, this debt was needed to be renegotiated or restructured one way or another, and that's what they managed to do with this announcement today. So 80 million or so of the debt will be equitized. An exit debt of about 800 million will be issued and due on 2030. And in the meantime, Spirit will get 300 million of debt in debtor in possession facility to go through the winter and continue to operate and make sure that flyer and passenger can still fly during this important holiday season.
Is there an expectation about when Spirit will come out of bankruptcy?
So they expect to exit the bankruptcy early March 2025. So there is an extension period of 40 days that is possible. That will still be early 2025, which is a very fast process. But it's also because they managed to pre-arrange most of the big hurdle before filing. So,
what could a new administration under President Trump free up some more merger possibilities that were kind of squashed? And does that sort of become Spirit's future in like April of 2025?
That's a good question.
That could be. Definitely, Spirit will emerge from this bankruptcy a leaner and hopefully more profitable in the long-term airlines, not necessarily in 2025. They only hope to get back to profits in 2026, which can be, even though very hard to achieve, but definitely leaner and better position and a more attractive airline for somebody else to grab. And definitely a change of an administration would likely make that easier for a new buyer.
So, what kind of looking at Spirit, are they a bad operator, or do they just have a bad capital structure?
No, they face a lot of headwinds from everywhere. Exiting from the pandemic, they faced higher costs because of pilots, because of everything getting more expensive. And at the same time, they faced strong competition from American, Delta, United Airlines, who were looking for passengers to fill seats that business travelers were not filling. And this was pressuring yields at low-cost airlines, including Spirit. And then on top of that, you add their engine problems that makes only everything worse, with 1 out of 10 airplane grounded, even though they got some compensation from Pratt & Whitney. So it's a combination of plenty of things, plus the fact that it seems that travelers are moving away from low-cost ticket to more premium fly. And that's why they are also changing their business model a little bit, offering more premium seats and services to their customers, and they're trying to change their experience. And this is not something that is specific to Spirit, but we also see that at Allegiant and Frontier because of this change in customer behavior.
Yeah, and also, then you add things. They make their money by, hey, I'm going to check a bag, I got to pay for something. I want a printed ticket, you got to pay for it. I want a cup of coffee, you got to pay for it. At some point, it's like, guys, enough with that. All right, thanks so much, Francois. We appreciate it. Francois Duflot, he joins us, Bloomberg Intelligence US Airlines Analyst, joining us from Princeton, New Jersey. Again, that ticker is SAVE. Also, nice. The big guys, like a Delta, United, for example, they can really compete on like lower fares if they want to at the end of the day too. Right. So how do you compete with that? Right,
and I didn't understand it, but now since Francois explained it, during the pandemic when they lost some of their business passengers, or a lot of their business passengers, they had to fill those seats, and so let's discount some prices and get those people in. Boom. So I think your question was the best, which is, now that we have a new administration, can we get a deal done with JetBlue or Frontier or one of those two? Because it doesn't seem like they can operate on their own, and it's the smaller markets that get hurt.
Exactly, because then you got to close maybe less flights, and it actually winds up hurting the people who need the flight there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. I was just listening to Charlie's report here. The NASDAQ up almost 0.9%. I said, what's pushing the NASDAQ higher? And I look over to the MOV function, Tesla. It accounts for 45 points of the move there in the NASDAQ. So Tesla stock up 7.2% today, leading NASDAQ higher. The question is, the Trump trade, is it a thing? How do you play it? Has it played out? Let's talk to somebody who does this stuff for a living. Carol Schleif, Chief Investment Officer for BMO Family Office. Carol, the world's a different place since the election on November 6th here. How did your investment outlook change, if at all?
It didn't really change. We're always very intent about building durable and sturdy portfolios. And actually, we had thought going into the election that, of a variety of potential outcomes, a red sweep actually was one of the most likely outcomes. And we didn't have high probabilities on any of them, if you will. It's not like it was run away, but it is interesting because you are trying to make sure that you're watching what the 10-year is doing and what treasuries are doing. So if anything, we've probably backed off a little bit on duration, and we had been underweight on the duration side anyway, and we had leaned into growth and into the United States and North American securities anyway. So we feel pretty good about the positioning and trying to be very adaptive in watching as things go forward.
It appeared that the gridlock scenario was a scenario that would work well for markets, but I'm not sure we're going to have a gridlock Congress and executive branch. It looks like it's going to be a clear sweep for the Republicans, and maybe they can get a lot of stuff done here. How do you position for that?
Well, the interesting thing is I think if you go back and you listen to the way when Chairman Powell was asked at the last FOMC conference call how they were going to adapt to the changes, and they said, look, until policy is there, we can't really start trying to model for it. And I think that's one of the approaches to take, because the market's trying to in advance discount which way things are going to swing. But come late January, depending on if we get across the board tariffs in the first week or two of a Trump administration, that's one potential policy response with portfolios, as opposed to a more gradual response or using tariffs as a negotiating tactic and an opening bid. So to pre-position portfolios is probably a little premature, if you will, but keeping adept at watching the way those things play out will be important. But it is ironic because historically markets have preferred gridlock, I think under the assumptions that if the legislators are all off bickering with each other, markets can get on with being markets. But clearly this time around, I think it was both not having to wait for the election outcome and having a decisive sort of tilt to it. The presumption is then, okay, fine, we'll get policy quickly, and then we'll be able to adapt and adjust. And so that unknown period shrunk from being what could have been months and months to being basically just a matter of weeks.
Something that's really stood out to me in the last few weeks is the outperformance of financials. Do you think that continues?
We do. And one of the things that's interesting is when you start digging into the stats and looking at how low the level of initial public offerings and M&A is. I saw one statistic recently that said something like 27,000 companies are sitting in venture capital portfolios. Over half of them have been there for over 4 years. So you've got a lot of really high quality potential companies that just haven't come public. You have a lot of M&A that hasn't happened, and that's teed up. I think that's one of the primary reasons why you're seeing Wall Street get pretty excited both, and we hear anecdotally there's a lot of bankers out there teeing up deals. Yeah. And so that could be positive for the industry.
All right, Carol, we appreciate it. Thank you very much, Carol Schleif, joining us there over at BMO Family Office. She's CIO over at that shop. Thank you so very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The NASDAQ up almost 0.9%. I said, what's pushing the NASDAQ higher? And I look over to the MOV function, Tesla. It accounts for 45 points of the move there in the NASDAQ. So Tesla stock up 7.2% today, leading the NASDAQ higher. The question is, the Trump trade, is it a thing? How do you play it? Has it played out? Let's talk to somebody who does this stuff for a living. Carol Schleif, Chief Investment Officer for BMO Family Office. Carol, the world's a different place since the election on November 6th here. How did your investment outlook change, if at all?
It didn't really change. We're always very intent about building durable and sturdy portfolios. And actually, we had thought going into the election that, of a variety of potential outcomes, a red sweep actually was one of the most likely outcomes. And we didn't have high probabilities on any of them, if you will. It's not like it was run away, but it is interesting because you are trying to make sure that you're watching what the 10-year is doing and what treasuries are doing. So if anything, we've probably backed off a little bit on duration, and we had been underweight on the duration side anyway, and we had leaned into growth and into the United States and North American securities anyway. So we feel pretty good about the positioning and trying to be very adaptive in watching as things go forward.
It appeared that the gridlock scenario was a scenario that would work well for markets, but I'm not sure we're going to have a gridlock Congress and an executive branch. It looks like it's going to be a clear sweep for the Republicans, and maybe they can get a lot of stuff done here. How do you position for that?
Well, the interesting thing is I think if you go back and you listen to the way when Chairman Powell was asked at the last FOMC conference call how they were going to adapt to the changes, and they said, look, until policy is there, we can't really start trying to model for it. And I think that's one of the approaches to take, because the market's trying to in advance discount which way things are going to swing. But come late January, depending on if we get across the board tariffs in the first week or two of a Trump administration, that's one potential policy response with portfolios, as opposed to a more gradual response or using tariffs as a negotiating tactic and an opening bid. So to pre-position portfolios is probably a little premature, if you will, but keeping adept at watching the way those things play out will be important. But it is ironic because historically markets have preferred gridlock, I think under the assumptions that if the legislators are all off bickering with each other, markets can get on with being markets. But clearly this time around, I think it was both not having to wait for the election outcome and having a decisive sort of tilt to it. The presumption is then, okay, fine, we'll get policy quickly, and then we'll be able to adapt and adjust. And so that unknown period shrunk from being what could have been months and months to being basically just a matter of weeks.
Something that's really stood out to me in the last few weeks is the outperformance of financials. Do you think that continues?
We do. And one of the things that's interesting is when you start digging into the stats and looking at how low the level of initial public offerings and M&A is. I saw one statistic recently that said something like 27,000 companies are sitting in venture capital portfolios. Over half of them have been there for over 4 years. So you've got a lot of really high quality potential companies that just haven't come public. You have a lot of M&A that hasn't happened, and that's teed up. I think that's one of the primary reasons why you're seeing Wall Street get pretty excited both, and we hear anecdotally there's a lot of bankers out there teeing up deals. Yeah. And so that could be positive for the industry.
All right, Carol, we appreciate it. Thank you very much. Carol Schleif joining us there over at BMO Family Office. She's CIO over at that shop. Thank you so very much. All right, let's go to Steve Mann now, Bloomberg Intelligence Global Autos and Industrial Research Manager. We were talking about Tesla earlier and how potentially the new Trump administration might loosen some regulation on self-driving cars. Now, this comes, though, as maybe EV subsidies will be rolled back, which is a bit of a head-scratcher for me. Steve Mann joins us now. Hey, Steve, what do you make of the fact that maybe those fully self-driving vehicles is a now hallmark or priority for the incoming transportation department?
Yeah, I think it's important. Full self-driving vehicles, it's the next kind of technology evolution for cars. And one of the biggest hurdles really in the US is regulations. There's only 2 states that allow self-driving cars, meaning without steering wheel and pedals on the road today is California and Texas. But nationally, the other states or the National Highway Safety Board actually do not allow these steering wheel-less and pedal-less vehicles on the road. So it's a huge evolution if they allow that.
So Elon Musk certainly having an influence there on this, presumably on this policy direction here, and Tesla stock is up 7.2% today. Steve, how likely is the federal government to kind of maybe follow California and Texas and allow these on the road?
Well, first of all, Tesla is not going to be the only one benefiting from it. GM could benefit from it. Waymo could benefit from it. Actually, GM's Cruise division has actually lobbied the National Highway Safety Board to really push rules and regulations, relax those regulations to allow unsupervised vehicles, more unsupervised vehicles on the road. But that's been held up for the last 2-3 years, and I mean personally, I think it's really important for the government to actually relax that regulation. It's not just the U.S. trying to develop this technology. There's a lot of companies in China, there's a lot of companies in Europe that are trying to develop this kind of a driverless technology. And I think, U.S. needs to do this to compete.
When you say that they need to do it to compete, wouldn't it be the same with EVs? And I'm wondering from maybe Elon Musk's point of view, if Tesla is able to sort of make a lot of inroads with the robo-taxis and self-driving cars, that in essence will also help prop up EVs because, oh, by the way, those cars will be electric.
Oh, that's very true. Those self-driving software is propulsion or powertrain agnostic, but having an EV really helps push that into the evolution into the future, because they do work better on EVs than gasoline cars.
So, Steve, just give us a sense of these self-driving vehicles. Where is the technology today, and when do you think it'll get to the point where
Paul's going to use one? Which,
yes,
by the way,
exactly.
let me tell you, it's going to be a while.
It's going to be a while. Where are we?
I mean, we still think it's going to take a while. Like when we look at, full autonomous vehicles as a main driver to Tesla's revenue, we don't really model that out until like 2035. So it's going to be a while, because it's really reliant on the AI technology, and specifically for Tesla, it's really using a lot of the data that it's collecting from its cameras in all the vehicles that are out there, and teaching the machine how to react and respond appropriately in various situations. As you know, as both of you drive on the road, there's umpteen number of scenarios that could happen. So it will take a while for the machine to really learn and be proficient at driving as well as a human being.
What else do you make of now if we just switch focus to just the EV part of Tesla or other companies, if that subsidy winds up going away for EVs, what do you think happens to the likes of like Rivian and Tesla and even the EV parts of major automakers?
Well, I think, the initial thought for us is really it could be beneficial to companies like Tesla and Rivian. If the credit goes away, I think EVs will still be around. There's still going to be some buyers who are really interested in driving EVs. Will it get past the 8% penetration rate, or will it drop down a little bit below 8? It could. But what that means is it's going to weed out a lot of competition. The unprofitable EV makers will have to probably exit the market. That will leave companies like Tesla, who's profitable. And the reason I bring up Rivian is because they have a huge backing from Volkswagen right now to really fund their next affordable vehicle.
So when I look at the Fords, the GMs of the world, what's their level of commitment to the electric vehicle business? Steve, has it changed in the last several years, or is it still there?
It hasn't for GM. And that's a good point, Paul, because I think the Trump administration will have to actually take that into consideration. With the Inflation Reduction Act, over $100 billion has been spent on kind of onshoring the EV supply chain. And for these companies to actually give that up and convert that to a sunk cost, it's not going to go very well with the car makers. So, for GM, they've invested a lot. They're rolling out cheaper and cheaper EVs. Next year, they're going to launch the Bolt, which is EV Chevrolet Bolt, which is under $30,000. But Ford, on the other hand, is quite different. They actually have retrenched. They delayed the battery, the new battery plant, and then they're also cutting back on a three-row EV SUV. But so depending on the different automakers, the different approaches. Yeah.
All right, Steve. As always, thank you very much. Steve Mann, Global Autos and Industrials Analyst for Bloomberg Intelligence. He's down there in our Princeton office. Again, it seems like the presence of Elon Musk is certainly influencing some of the transportation policy that may be coming down the pipe.
Would you be more apt to buy an EV or a self-driving car?
EV.
Okay.
Yes. But, I think about it. Every morning I get in a car with some dude I've never met before. What's kind of the difference?
Between self-driving and that? No,
Yeah,
it's a good point. I mean, at least when it comes to, say, transportation like cabs and taxis.
Yes.
Would you get into a self-driving taxi?
I don't know.
No, he's not there yet.
Yeah.
I don't know if I would.
I don't know. We'll have to see. All right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business. Where am I doing? In business, economics, and finance.
Yep.
Thank you very much.
Boom.
It's like riding a bike until you hit a speed bump. All across the world. We also will have to tap into our Bloomberg NEF folks. So Bloomberg NEF research basically powers data sets and models for everything from commodities to power, transport, industry, buildings, ag sectors. It's all about businesses helping to finance the energy transition. ... What does a Trump 2.0 mean for something called the energy transition? Joining us now is Derrick Flakoll, Bloomberg NEF lead U.S. policy analyst. What do we think a Trump 2.0 and energy means?
So first of all, there's a lot of worries about the future of the Inflation Reduction Act, the U.S.'s signature climate subsidy program. We expect that will mostly remain intact. A lot of Republican districts and states are benefiting. 14 House Republicans have signed a letter saying they don't want to see those tax credits repealed hastily, and the Speaker of the House has said that he wants to use a scalpel, not a sledgehammer. So we think a lot of that will survive. Where you're likely to see more change is regulations and some voluntary initiatives like the procurement for clean products from the federal government.
So I'm just looking, you have a great chart graphic here. Fossil fuels are likely to fare well under a Trump administration. Electric vehicles are not. Wouldn't Mr. Musk have something to say about the fate of electric vehicles?
He certainly would, but the question is, what is Tesla's strategy going to be vis-a-vis other electric vehicle producers? Most of the valuation comes from the dream of a robo-taxi, and we've certainly seen some Bloomberg reporting recently saying that Musk is likely to push for a favorable framework on AVs. When it comes to EVs or electric vehicles, he has said, and the business analysts may or may not bear this out, that Tesla would do better sort of survive the loss of the EV tax credits in a way that some of his EV competitors might not. It ultimately depends on what you and what he thinks Tesla's interest is, whether it's dominating a smaller EV market or having a smaller share of a larger EV market.
Let's move to some of the stuff that feels a little bit dicier, and those are the tax credits that are part of the IRA. So one is a tax credit for carbon that's captured. How you store it and how you capture it is debatable in terms of how much tax credit you receive, and the other has to do with hydrogen. How do we feel about those two policies either staying in place or getting reduced?
So these tax credits are favored by, industrial interests, oil and gas interests. From what I've heard, there's not a lot of Republican appetite to repeal either of those. What you're likely to see is looser regulations on both, which actually strengthens the business case for both. We might see a better outlook for both carbon capture and for hydrogen under Trump administration. Now, as for emissions benefits, the market acceptance of that might be a little bit dicier. But nevertheless, we see the economic case for those being a little bit easier as compliance costs go down.
So I'm just looking again, winners and losers here. How much of this is a day one type of policy thing versus, boy, this is just take a while, to the extent the Trump administration may want to shift gears on this energy transition. It seems like a lot of stuff has already been spent. There's a lot of investment already in the ground. What's the timing, do you think?
Right. Well, it depends on what you're talking about. If you're talking about taxes, there's going to be a big tax negotiation taking up probably most of 2025 to do with extending the Trump tax cuts, seeing what happens with the IRA, et cetera. You're likely to see closure on that by the end of the year, but after that will come regulatory changes and so forth. In general, regulatory changes, including those for existing tax credits, take usually about 2 or 3 years, give or take. And so a lot of this stuff can't really happen on day one. You can't really shift the ship on a dime. However, in terms of tariffs, those are things that can be done more or less immediately, though politically that might not fly too well. And programs that are sort of voluntary, like, again, federal procurement of clean products, those could be killed more or less day one by an executive order.
What about wind and solar? So to some extent, a lot has already been thrown into that, and it's hard to see onshore wind and solar. It's hard for me to reconcile that being really stripped away. But the offshore wind space, that has question marks for me.
Yeah, it does have quite a few. If you look at BNEF's modeling for what might happen if the IRA were repealed at the earliest opportunity, which again, we don't think will happen, but even if it did, you would see about a 17% drop overall in the combination of wind, solar, and storage installations. Wind itself, though, would see a much bigger drop because it's very expensive and tax credit dependent. You might see about like 30% drop in onshore wind and an over 40% drop in offshore wind, and that's only based on the financial subsidies, right? Trump has a lot more control over offshore leasing as well as federal permits. There's a pipeline of projects that already have both offshore leases and permits, but a lot of proposed ones don't have that yet. And there's also questions about how the administration would approach litigation against existing offshore wind permits. You might see some of that fall by the wayside depending on how lawsuits go.
Derrick, just broadly defined, how committed is Congress as a legislative body to this whole energy transition? Do they feel like it's real, or how do they feel about it?
Are facilities being built in their states?
Yeah, that's
that
probably
may
a good
actually
answer.
change the answer to that.
Exactly. From what we've tracked in clean tech factory deployments, I think about 90% is going to red or purple, that is swing states. So there's a lot of electoral consequences, especially if you zoom down at the district level, where overwhelmingly it's Republican districts with cheap land, better labor costs, rich resources. These are the places that are seeing the most investment. And so I think the commitment primarily is to economic development, local opportunity, as well as to some degree onshoring and supply chain diversification and de-risking. And that, I think, is fairly durable in a bipartisan manner.
All right, the most important question of the day, Derrick, for you. Are the UNC Tar Heels, are they even going to be able to field a basketball team this year? Go up against my Dukies?
Well, my wife's from Duke, so I'm gonna not take a position on that.
Smart man.
Very
All right,
smart.
very good. All right, Derrick, thanks so much for your appreciate it, Derrick Flakoll, lead U.S. policy analyst for BNEF. Again, one of my thoughts here as we think about it from an energy perspective, it just seems like there's so much, or there is a certain degree of just movement towards cleaner energy. that I'm not sure to how you stop it, much less slow it down. But I guess there are certain things that you could do executive order day one.
Yeah, I just think it's also going to be sort of a pick and choose, right? Like I mentioned, sort of the carbon credit tax credit, you could see that staying, but hydrogen feels like a real question mark, maybe more of a push into nuclear. So like there's some nuances there. And also what happens with coal. If you're going to shutter a coal plant, or if you have a clean coal plant, like does that change your calculus?
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.